Hello, good afternoon. You're watching Closing Trades on ET now. I'm Anisha Jain, with me Sasha Faridi, and the closing trades are looking very, very smart. If you're a bull, there's too much to rejoice today, because it's not only fresh record highs that we have scaled, but we have managed to build onto those gains so comfortably above 21,100 throughout the trading session today, and it's been fairly broad-based. If you look at the broader markets, they have been doing well. All the rate sensitives are the ones which are actually powering ahead. So whether it's a financial space, banking, as well as NBFCs, or real estate, autos for that matter, all of those stocks are seeing massive gains. And of course, IT is the pack which is leading from the front today. So that entire expectation that there's going to be a soft landing, there is going to be a bit of comeback of the growth stocks and risk on. All of that means that the IT stocks are the ones which are powering ahead, and especially the mid-cap IT, that is. So an Emphasis, a Mastech, a InfoEdge, and rest of the names as well, like Sonata Software, are doing quite well for themselves. What is also doing well is metal, so that's also shining away. But on the back foot, we have the insurance names that are coming under pressure, and that's the impact of the ET Now exclusive on account of the surrender value going up. So all of these stocks are under pressure, but barring that, Aisha, and barring maybe a Z Entertainment, it's mostly green on the screen.
Yes, it sure is, as it is in the studio too, Anisha. But yeah, we're holding up pretty smartly. Metals, IT, they're the ones clearly which are leading the charge. But what about the next leap forward for the market? Where is that going to come in from? And if you were to really stack up emerging market peers amidst India in terms of valuation, past performance, who's actually going to win the race? And who better than Nilesh Shah, MD at Kotak AMC, to answer just that? Nilesh, just taking a cue from your last tweet, who's going to win the race? Valuation or past performance?
A very, very tough question. But my feeling is that in today's environment, Indian valuations are justifying its past performance, and let's pray that we deliver future performance in such manner that this valuation sustain.
So the valuations will sustain, but you've also just come out with your market outlook for 2024. So in a gist, tell us what we should expect, because at the start of 2023, everybody was talking about maybe a paltry single-digit growth and low single-digit from the Indian markets, but we have beaten that. What's the expectation for 2024 now?
So one, we have learned from our past errors that never try to predict the market. Our market outlook does not try to predict the market. We try to give data points to the investors so that they can fill those data points to arrive at their own conclusions over a period of time. For example, today we are saying that US Fed is maintaining a very, very delicate balancing between growth and inflation. By raising rates, they have controlled inflation, but by not taking out liquidity as quickly, they have supported growth. So continue to focus between liquidity versus rates. We are also saying that on one side, fiscal expansion is happening in most Western world, which is negating the impact of rising interest rates by central banks. Don't just watch central banks' interest rate policy, also keep a watch on the fiscal side of the government. In the Indian context, we see pockets of irrational exuberance in SME exchange, in some low floating stock counters. We are bringing valuation in front of our investors that, look, these are the stocks where floating stock is limited and hence probably valuations are high. If not today, tomorrow, divestment supply could emerge, promoter selling could emerge, and those valuations are unlikely to sustain. So our whole objective is to equip our readers with data points so that events happening in 2024 can help them guide towards appropriate allocation.
That's exactly the point, Nilesh. Will the market cap follow robust earnings growth, or you think the market overall per se has run up ahead of the kind of growth projections we're currently working with, and what the potential could be for the next fiscal?
So market undoubtedly keeps on discounting future sometimes more than necessary, sometimes less than necessary. But that's the nature of the beast. We believe Indian markets today are discounting the future growth trajectory. But beyond that also there is a growth which markets may not have discounted. Today we are benefiting from, let's say, there is no other credible alternative in emerging market. Russia is a shut door. China, Taiwan have their geopolitical risk. South Korea could be upgraded into developed world. Turkey, Indonesia, Mexico, Vietnam, these are smaller markets, uni-focused markets. In emerging market, there is no alternative to India. The second thing is our own governance standards. Today, when the world looks at investment, governance is critical for them. India stands apart and ahead of all emerging market peers. The third thing which people are noticing, even though we are not talking about, is green transformation of our economy. We are the lowest per capita carbon emitter in the world. We have created growth without damaging environment as much as some of the other peers. Combination of this 3G, growth, governance and green, and on top of it policy stability, it makes India an unbeatable combination, and which is why while our past performance is impressive, our future potential also continues to look impressive.
And Nilesh, while you've learned from your error and not trying to, time the market or establish the values we should look for in terms of the Nifty, but at least theme-wise, talk to us about which theme looked good, because of course this year was about capex, railways, defense, even in parts, rural recovery, etc. Do you think these things will continue into 2024 as well?
So one thing where we have been wrong for last 6 months is banking and financial services. Valuations are near their historical lower quartiles. Deposit and credit growth is in double digit. NPA pressure is reasonably under control, even though there are some concerns on unsecured loan. And most importantly, selling by FPIs probably seems to be behind us. Net financial services is one sector, especially private sector banks, where there could be bottoming out. The second sector which you mentioned, information technology, it has underperformed market for last 1.5 years. We have been observing net employee intake or recruitment by IT sector, and we are also looking at conversion cycle from inquiries to order in the global firm. We believe it will be difficult to predict this to the pinpoint accuracy, but clearly we'll be able to read the trend and accordingly will build positions in IT sector over next 3 to 6 months. Apart from that, the trend which is continuing from the past is manufacturing in India. There are many companies who are leader in domestic market and now they are supplying to global chain, their parents or someone else. It's kind of double engine growth for them, local as well as global. There are companies which are becoming part of global supply chain management and their scales are expanding at a much higher level. We think manufacturing across variety of products could be bottom-up opportunity and a far longer-term trend thanks to China plus one. More importantly, it's to ensure that we don't make mistakes. So we are not there in low floating stock counters, even though we suffer in the short term in terms of performance. We are largely focused on valuation and trying to shade expensive valuations in favor of a reasonable valuation. So one, we are ensuring that we don't make mistakes. And second, we are trying to bet upon reasonable valuations within banking, IT, and manufacturing theme.
That's the other thing, Nilesh. While the positives are much known and there is that momentum chasing us, and once the foreign flows as well kick in thick and fast, sky's the limit. But what about the headwinds that the market could face?
So as of today, the way market is positioned, unless headwinds are worse than what is feared or expected by the market, every correction is likely to be shallower than expected by the market, and a rise is likely to be higher than expected by the market. We did see last time many people were expecting 18,000, 18,200 Nifty to bottom, and market turned around at 18,800. We did expect, market was expecting about 20,500 to be the top, and today we are at 21,000. Because there is cash waiting to be invested in the market across local and global investors, we'll have to keep in mind that despite headwinds, corrections will be shallower and the rise could be higher. The one big worry for markets will be policy stability. Today, market is discounting continuity on governance and continuity of policies. If there is any change over there, then certainly there could be some reaction. India today is trading at a premium valuation to others. As Spider-Man movie said, with great power comes great responsibilities. With higher valuation comes higher expectation. So our headwind will be to meet those expectations, to deliver on those expectations. We are like Surya Kumar Yadav or Virat Kohli. We are supposed to score century every time we come to bet. A 10-run, 30-run cameo is not good enough.
Nilesh, on that note, we'll let you go. Hope we hit a century and not just a small cameo coming in from the participants, because there are the strength of the bench we have for us in the Indian market is quite strong. So I don't think that should be a big problem. But on that note, we'll let you go. Appreciate you joining us on the show. The market is doing all right. Nothing much to complain. So time now to slip into a very short break. But as we do that, listen into this exclusive conversation my colleague Sumit Chaturvedi had.
Like all the transformation measures, it was really brought exemplary results, and which has benefited every citizen of the country, every state, every part of the country. Honorable Prime Minister have taken everybody along. Sabka Saath, Sabka Vikas. In the truest sense, taking this particular commitment, he have worked day and night with best of his sincerity, commitment, dedication, and as a result, with his correct policy and program, whether it is Digital India, Make in India, all the kind of program become a successful program, which has paid a lot of dividends to the growth of the India. And because of this particular initiative, India became the 5th largest economy in the world.
Nilesh, you think this move in IT is sustainable?
We'll see sustainable moves in stocks which have been clearly showing strength. And we are seeing strength in something like a LTI Mindtree. You have HCL Tech, which hits a new all-time high and it continues. The concerns have been in terms of follow-up only on Infosys TCS, which have not seen strong follow-up on breakouts. But today's move after yesterday's downtick is actually a good indication that this could continue further, but it would be slow and steady. But there are clear leaders in the mid-cap and the broader IT names, apart from the Infosys and TCS names. But yes, looks like this momentum could continue much more in the mid-caps and a little more in the larger ones.
That's the take coming in on IT. Let's welcome on board Sandeep Sabharwal well and find out what he's making of the market texture right now. Sandeep, hi, afternoon. It's almost like the market is believing that next RBI policy and you're surely going to see a rate cut. Is there a correlation? Should one also anticipate a rate easing by RBI?
So it looks highly unlikely that we are going to see a rate cut anytime soon. However, I think the scenario that's building in globally right now is that the rate hike cycle clearly seems to have ended. And once that happens, we'll see that the dollar index peaks out, flows start into emerging markets, etc. So I think that's the phenomenon we could see. On the flip side, in anticipation of all of this, we have already seen the market run up around 2,500 points almost in a straight line. So it calls for exercising some sort of caution at this stage, because suddenly a lot of people were very bearish in October. Now I see everyone being bullish. So that becomes something we should be cautious of.
But Sandeep, then what do? You obviously will not put fresh money to work at these levels, but do you also profit take?
So holding some amount of cash is prudent in potentially sectors where the run up has been too swift, or where someone has an overexposure, and then wait for some corrections to allocate that. But the overall economic outlook is positive, so we can't go very hugely into cash. So maybe a 10-15% cash position could be potentially prudent. And then in between, opportunities will keep on coming up, because all stocks don't correct at the same time. So sometimes some stocks have not moved, the market is ignoring that, and you can allocate to that.
Okay, point taken, but I also wanted to put the spotlight on the IT stocks because they are the ones which are firing away in the trading session. Nifty IT is, of course, sitting at 52-week high levels, the best that we have seen since April of 2022. A lot of reasons for the tailwinds. Of course, Nasdaq is one space which has been rallying, so a bit of a runoff. The interest rate cut will improve the DCF valuation, so that is what the support that these stocks are getting. Risk of recession also kind of reduces because they are talking about easing ahead of the curve. And then there was this study done by HFS talking about how the IT spends in 2024 are likely to inch up by around 9% as compared to the low single digit number that we had seen in 2023. Of course, Q3 is going to be muted, but then a lot of analysts believe that it's just not prudent to time the market. Perhaps we are towards the end of the bottom, so it's good time then to start accumulating. But if you look at the valuation wise comparison, Nifty IT is now trading at a forward valuation of almost 25 times, while the 5-year average is sub 23 times. So the valuations are not comfortable. And even if you look at the rest of the IT names, and they will come up for you on the screen, the valuation of the individual names are also quite significant in terms of the valuation of the individual names. But Sandeep, what's your view on IT? Would you concur with the view that it's time to start maybe adding in parts, or still stay away? There'll be better level coming when the Q3 weakness is reported in numbers.
I would say that a Q3 poor results are already expected by the. So to that extent, any poor result at that time should not affect these stocks so negatively. The key is what sort of revival cycle we see next year and what kind of growth comes in. So given the fact that in extremely negative situation, we've seen these stocks hold up. In fact, the mid caps have rallied substantially. So now we need growth of at least 10% or more for the industry, for the overall stocks to do well, because it's not an under-owned sector. I think most funds own significant amount of IT stocks despite the downturn. So I think for people who don't own, they should start allocating. For people who have reasonable exposure, I don't think we should go overweight right now.
Okay, here's some interesting, data as we head into a brand new year. Let's also take a look at how India shopped online. And my colleague Ankita is here with the breakdown of a report coming in from Bain Capital.
Well, that's correct. Let's quickly look at how India is shopping in 2023, and it's a report by Bain and Company. Now, e-retail has been a disruptive force, in the global retail market. Now, the online-first retailers, in fact, constitute 2/3 of the total sales generated by the top 10 global retailers, and there has been a threefold increase in that over the last decade. Now, COVID-19 2014 had really accelerated the e-retail business, and that has largely remained steady over the years. Now, this year, we will examine it on 5 major themes that, that are going on in e-retail space in India. First is the long-term growth fundamentals, the shopper micro segments, the emerging business models focus on profitability, and the role that generative AI will be playing. Now, India's long-term growth fundamentals look absolutely robust. India's market is estimated to scale to $57 to $60 billion in 2023, adding almost $8 to $12 billion annually since the year 2020. Now, India's annual transacting e-retail shopper base is estimated to scale 230 to 250 million people in 2023. Over 100 million of these shoppers have been added just in the last 3 years. Now, diverse consumer micro segments have also been more salient if you look at it. Now, 7 out of 10 shoppers, reside in the tier 2 cities. A third of the shoppers come from Gen Z, and a third of the shoppers actually come from the lower income cohort group. Also catering to these segments, we saw the emergence of 4 e-tail models, the e-tail business models, which are quick commerce, hyper value commerce, inspiration-led commerce, and fast fashion. Now, finally, the role of generative AI will fundamentally alter the e-retail experience. A series of high-impact use cases are emerging that will positively impact the shoppers and the sellers' journey. Now, the e-retailers are looking at technology, to disrupt basically 5 areas of shopping, which is discovery, seller enablement, target marketing, consumer support, and business efficiency. Now, the next chapter in India's e-retail growth looks very promising, definitely very, very exhilarating, enabled by generative AI, and the industry is likely to push these boundaries ahead.
We're putting that into perspective. So that's how India has shopped in 2023, but we are putting in perspective the trends that might be there in 2024 as well. But Naresh, coming to you, a couple of counters from the metal basket are actually doing quite well for themselves. SAIL is higher by 8%, NALCO is up 5%. Any name that you like from the metals pack?
So SAIL and NALCO have higher volatility, and they keep getting into derivative band in and out of it. So out of the metal names, I would go with Hindalco, which looks because the stock has been a slow and steady trend in the last 1.5 months, and has started crossing highs made last in 2022 and has been sustaining well. So I would expect Hindalco would be the first one which could actually go back and hit the highs made in 2022, which is closer to 600, 630 mark. So at current levels as well as on dip, Hindalco is where there's a good risk reward.
Sandeep, just taking a leaf from what Ankita was flagging off in terms of, what the shopping trends are in India, and broaden that a little bit, when do you think the rural recovery will make a meaningful comeback? And would you say that that's a contra trend that we should play by, or do you think go with the writing on the wall, urban India, premiumization, those are the themes which are working well, so stick by with that?
There was an anticipation that we'll see a rural recovery going into the second half of this year. However, cropping patterns due to low soil moisture, as well as lesser income across the entire integrated scale, has led to rural demand continuing to be weak for now. So what do we look for next? So next will be now going into looking at the next monsoons and the impact of that. So I think rural recovery, I would say, is still somewhere.
Rural recovery is some time away, that's the word coming in. But one space which is coming under pressure today, as we flagged out, is insurance. Kunal, what's your view? Should one look at buying the dip that you're seeing on the likes of Max Financial, HDFC Life, SBI Life? I'm guessing the alpha is a bit low in these names, not a very,
beta.
Yeah, the beta rather is a bit low given the fact they're not very volatile. So what's the take?
Yeah, I think the beta is low, but these stocks are, have already confirmed a breakout for themselves. So, one of the characteristics which we look out for is that if the stocks give breakout for themselves on the medium-term charts, on the long-term charts, and if they're actually low to moderate beta, then we actually would want to ride the trend for these stocks and would probably try and participate or maybe add positions in case if these stocks go into a one-off phase of correction. So I think that's a classical sign that these stocks are trying to migrate to a higher level, and in that process, in case of these stocks, they give you some high-priced up moves or in a short duration of time, then the beta tends to lower down when these stocks go into a correction phase. So I think that's a classical sign that you should be ideally looking to buy these stocks on dips. Now from the insurance pack, two of the stocks which we've been bullish on would continue to stay bullish would be HDFC Life as well as SBI Life. I think SBI Life predominantly has been one of the more stronger names, a V-shaped recovery for the stock price in the last, I think 3 months or 4 months approximately after a sharp correction in the month of August. And HDFC Life has also been a very slow, gradual and consistent mover. So both of these stocks look attractive to me.
So the risk beta is low and hence the alpha generation in these names is also lower. But time now to go across to Anurag to get a sense as to what the story is and its implication. Anurag?
This is a major development in life insurance space. Insurance regulator IRDA has come up with a draft exposure draft related to the product regulation in life insurance sector, and which mentions the change in formula to calculate surrender value and surrender charges of life insurance product, non-par life insurance product. So as per the exposure draft, the surrender value will increase and surrender charges will decrease. So it will be beneficial for policyholder, but will impact the margins of life insurance companies in their non-par segment. Although this is an exposure draft, so final draft paper, final rules will be implemented after the consultation with all the stakeholders, and life insurance companies will also put forth their viewpoint related to this exposure draft. But indeed, it's a very big development as far as related to the life insurance space, where a formula to calculate the surrender value and surrender charges in non-par insurance product will change, and which will benefit the policy holders.
Intent is always for the common good of people, policyholders, and for the entire ecosystem. So a lot of actuarial calculations go behind it, and depending on the calculation on certain kind of products, not all products like that, certain kind of products. So there is a thought process going on, and it will be discussed, deliberated, and what will be the best solutions available. So that will be adopted. So these are the things. So it is now too premature at this stage to come to any conclusion on all these things. So it's an ongoing process, whether it is processes for claim settlement of maturity claims, death claims. So these are all that will...
So sir, this will be beneficial for the policy holders, because we see that in most of the time after 3 years, policy holder get the surrender value in a very less amount. So that it will impact the policy holder. The persistency rate in life insurance will go up, and the overall surrender value will increase.
What happens is whoever that means manages certain affairs, they take into account the views and benefits of all stakeholders. So, and policyholders' stake is definitely important because they are large number, and but at the same time, all stakeholders' views are taken into account, and accordingly decisions are taken. Okay. So it's an ongoing process. So for many things it happens like that.
So it's an exposure draft, and you will take consultation from all the stakeholders like insurance companies, like agents and policy holders. And by when it will get implemented, sir?
The process is there. So normally nobody should rush into processes. So the processes should go on, and it will take its own time. Yes, but and it normally happens usual time what it takes for all other things.
Well, welcome back. For now, the market is holding up okay. In fact, 20,200 seems to be in sight for the market for now. But let's take a look at some of the price volume buzzers as well before we move ahead. Steel Authority of India, sale is higher by 8%. It's seen a breakout from the rounding bottom chart pattern, has hit a one-year high on an intraday basis, and the volumes too are 6 times the 20-day average that we have seen. So quite a bit of momentum on Steel Authority of India. Info Edge as well has seen a bit of a breakout. It's hit a 22-month high on an intraday basis, and the volumes again 6 times the 20-day average that we have seen. You also have Persistent Systems, which has seen a record high level being touched today. That stock has actually seen quite a bit of run up this year. It's been advancing for 5th consecutive month. Kunal, your take between these three buzzers, Steel Authority, Info Edge, Persistent. If you had to buy one stock, what would be the one? Which would be the one?
Steel Authority. I think that's a stock which has been a huge underperformer. So it's the sector making a comeback, and from the sector there has now been a decisive breakout on Steel Authority. So I think that's a very strong breakout. As you rightly mentioned, it's a rounding bottom pattern for Steel Authority, which means that the stock would probably not just go into a short-term uptrend or a breakout mode, but this could be a very strong and swift uptrend for the stock, which could last for a longer duration of time. And going with the beta nature of the metal pack, SAIL is apparently one of the more moderate beta stocks from the entire high beta sector like metals. So if the stock has to get into a breakout, it has to get back into line with respect to the beta for the rest of the pack, which could also provide an additional boost to the stock price. So I believe possibly a 125 to 140 could be a target range for the stock.
Right. Let's welcome on board Mayuresh Joshi as well and talk about some of these buzzers in trade. Hi, afternoon. What do you think is aiding the move in metals, and do you think it's sustainable?
Afternoon, Aisha. I think 2-3 factors that are clearly aiding the kind of growth that is now coming through for the sector as a whole. One, yesterday Powell's statement, which is clearly indicating that at some stage in the second half of the next calendar year, rate cuts will be a given. That will give a boost, huge boost to the global economy, and commodities in general should see a huge comeback. The second element is around the same periodicity of time, large expectations are getting laid out that China should see the initial signs of recovery. And as those recovery signs become a little bit more eminent, the expectations in terms of restocking, which will start happening across the metal pack, whether it's ferrous, whether it's non-ferrous, will start boosting LME prices. So as demand comes back slowly and steadily as far as China is concerned, the expectations of a soft landing in the US, strong recovery signs that we are seeing in Europe, and holding out of macros and the expectations of infra spend in India, I think that is what is expected to keep volumes afloat as far as Indian companies are concerned. And with a sharp recovery in LME prices, the large expectation is that operating leverage should start kicking in from the first of the next financial year. So I think it's a preemptive move that you're probably seeing on a lot of these counters. But I think a lot of these domestic oriented companies, Aisha, as far as the metal space is concerned, should do relatively better. We had markets with India like Jindal Stainless. Yes, the stock has moved up along with the entire pack, but our entire take is the numbers were very, very good in the quarter gone by. The reported EBITDA per ton in excess of 20,000 for the first half should show signs of improvement as we do the next few quarters and as a serious economic recovery takes place across the globe. And therefore, volumes, value-added products, the expectations in terms of better margins coming through and a better reported EBITDA per ton should probably raise EPS estimates even for the next financial year. I think general tailwind for the sector, our top pick probably remains Jindal Stainless.
Mayuresh, what about IT as a pack? And given the kind of flare-up that you're currently seeing, perhaps catch up with the way the Nasdaq stocks have been performing, and especially in light of the announcements coming in from the Fed. For those who are underinvested or not invested at all in IT, you think it's time to buy?
So mid-cap IT, Aisha, has been a strong outperformer, and the outperformance continues even today in today's move. So I think the huge move that you've probably seen in a large part of the mid-cap IT spectrum gets a boost, as you rightfully put forward, in terms of the comments from the Fed, the expectations of a soft landing, which probably means discretionary spending at the client end, specifically in these pockets of $1 million to 10 million, where a lot of these mid-cap IT companies work out with, that should have steady inflows. And a lot of commentaries are pointing to that. So they are not seeing any kind of pricing pressure. The demand still remains extremely strong and robust. And put these two factors together, the dollar and constant currency revenue growth expected to be stable. A large part of the wage hike is behind us, and therefore the EBIT performance should be relatively better in the next few quarters. Valuations obviously are sky high as we speak, not just compared to their own median averages on what mid-cap IT used to trade 5 years back, but even the discount, rather the premium has probably widened between mid and large cap. But yes, anybody who's not invested, to answer your questions, can start with small tranches within the space, within the mid-cap IT space. We do like a couple of names which you hold in our global lists. Scient is something that we continue to like because of its diversified book, expectations of stable revenue growth. And Firstsource Solutions probably meets a lot of our criteria in terms of revenue expectations, capacity utilizations, decent amount of DSO days, and a decent amount of diversified book as well. So I think Scient and Firstsource can be accumulated on branches by fresh investors.
Kunal, is it a no-go for the benchmark large cap IT names, your TechM, Infosys, TCS still?
No, I think it's a definite go, Aisha, for the large cap IT stocks. In fact, what I'm actually liking is not that so we of course have discussed TCS, Infosys earlier, that how I flagged off that these stocks are getting into a breakout of a swing pattern for their respective charts. But I think what I also like is Wipro making a comeback. I think that's been a huge underperformer from the large cap IT stocks. I think at 425, 430 where the stock is trading, it is looking a much more stronger chart than what it has been over the last 1.5 years for itself. So that I strongly believe that if the large cap IT stocks have to make a comeback, I think would not be an underperformer in this leg, and it should probably get back into line of at least an at par performance with the large cap stocks or much better performance. So my sense is that I would probably expect the stock to come back towards 480, 500, possibly in the next 1 to 3 months.
Okay. A block deal on Bandhan Bank, by the way, about 0.3% equity changing hands there. There's also a lot of activity within the Realty pack once again. So Godrej Properties holding up a solid 6.5% nearabouts in trade. And of course, the others are all from the metals and IT pack. But Naresh, any fresh ideas within Realty, you think?
So in real estate space, Godrej Property is the one which looks promising for the fact that it is a stock which has still not gone back to the highs made in 2021. And it's been a slow and steady move in the last 2 months. It gave a breakout of about 1750, 1780 levels. Today, it has barely reached around the 2000 mark. So this is a stock where still the risk reward fits in. One can keep a stop loss below 1900. And the momentum, if it continues, it could take it towards the 2300 to 2500 mark. The rest of the names have already moved up quite a bit. The only options are to go a little more towards the small cap side. So something like a Kolte Patil or a Ajmera Realty, which have been sideways in the last 1 month, could be interesting.
That's the take coming in on Realty. Mayuresh, Realty has been the best performers year to date. Do you think stocks have run ahead of the fundamentals, or would you say that this is a multi-year cycle and there is still phenomenal money to be made here?
Yeah, so I think if you go by the previous historical cycles that real estate has gone through, obviously it remains to be a 6-7 year old cycle, and we are in the middle of that range, and therefore there are still some legs to go. Obviously, the tailwinds which are aiding the kind of growth that you've probably seen, which are getting reflected in numbers. Pre-launches are getting very well accepted, specifically the premium and the ultra-premium launches. You've seen examples like DLF, an example in Kolte Patil as well. And therefore, I think new launches getting very well absorbed by the market itself. The second element in terms of unsold inventory has come off significantly in the last few quarters. And with the rate cut cycle, again, that can get initiated. All these rate sensitives will be back in focus. So yeah, more legs to probably go. A lot of companies have deleveraged their balance sheets to a large extent. And therefore, the kind of earnings momentum that one can expect from these stocks can very well continue. Obviously, I think historical valuations and where they are trading at the juncture are fairly valued as we speak. But if earnings are expected to come strongly in the next few quarters, my own sense is that the momentum can very well continue, assuming we are in the mid of that cycle. Stocks like DLF, Godrej Property, if somebody is holding, definitely hold on. But even within that mid-cap range, you can probably start scouting for stocks which can also have some element of budget connotations to it. So obviously, I think the interim budget will have some focus in terms of affordable housing. And with affordable housing, again, taking precedence as far as budgetary allocations are concerned, a few of these stocks can very well in momentum. So something like a Brigade can definitely be kept on there.
Taken, but of course Infosys is one stock at the index level which is contributing the most because that stock is up almost 4%. But Reliance also actually saw some large trades happening. That stock is higher by over 1%. And HDFC Bank too is in focus because tomorrow there are some readjustments which are expected, and that means there could be inflow to the tune of $450 million. We'll get Sumit shortly to join us to talk to us about what those rebalancing are. But before that, Naresh, tell me your view on Reliance as well as HDFC Bank.
So both have been a slow and steady mover. If we look at Reliance Industries, 25 or 2475 was the high a few days. 2475 was also the breakdown point back in August, September. So that is the price point I would be watching out for. If it sustains above that, it gets into further momentum and could even go and test that 2600 mark. So overall, looks like a flag formation here. Has come close to that 2475 mark. If it sustains, could see follow-up momentum. HDFC Bank has finally made that recovery back to the highs of 1650, 1670 of the last few months. But the problem remains, if we go back all the way to 3 years, 1650 to 1700 has been a tough area for the stock. So a longer term bull market or a major trend change happens if it starts sustaining about 1700 on a weekly basis. So at current levels, it's too early to call that. So Reliance Industries looks a little more promising than compared to HDFC Bank.
Okay, in fact, since Anisha just flagged off that FTSE rebalancing, let me take it across to Sumit and find out exactly what are the names which are going to partake in this, and more importantly, what's the fund flow action we're likely to see.
Well, multiple rebalancing events tomorrow. In fact, to be precise, 3 of them. Firstly, when it comes to the Dow Jones ESG index, Embassy Office Park REIT, JSW Steel, UPL, Godrej Properties and Macrotech Developers are being added to the Dow Jones Sustainability Emerging Market Index, while in the Dow Jones Sustainability World Index, 3 stocks are getting added, that is JSW Steel, UPL and Dr. Reddy. When it comes to FTSE, around $525 million of inflows are expected in selected stocks. Firstly, it's Nexus REIT, where around $9 million of inflow are expected to come in, which is nearly 28 times its average daily volumes. In Mankind Pharma, around $28 million of inflows are expected, which is around 5.5 times its average daily volume. Now, these 2 stocks are getting added into the FTSE indices, while there are few stocks whose weightages will increase in the FTSE index, and that is HDFC Bank. Firstly, $451 million of inflows are expected in HDFC Bank, around 1.7 times 20-day average volume. Apart from that, there is Sheela Foam and Nazara Tech, which could see inflows of anywhere between $1 to $3 million. Now, a couple of stocks where the weightage could reduce, that is 361 and Delivery. Outflows of around $3 to $10 million are expected. And the last rebalancing event would be in the BSE 100, which is a very actively tracked index of the BSE. And there are 7 stocks that are getting added in the index, that is PFC, Hindustan Aeronautics, TVS Motors, Yes Bank, Persistence and APL Apollo Tubes and IDFC First Bank. And 7 stocks that are getting excluded from the index are Adani Power, Tata Elxsi, Emphasis, Voltas, CG Consumer, Bandhan Bank and ACC. So keep an eye out for all the stocks in trade, because there could be some movement in trade tomorrow, given the fact that there would be inflows and outflows in these stocks.
Mayuresh, as we pretty much would start winding down the year, any pockets you think wherein the fundamentals or rather wherein the valuations have run up ahead of the fundamentals and one now needs to ease out within the pockets?
So I say, is it the power space that you're speaking, or
are there any such pockets? Power, of course, came from you.
Yeah, sorry, I lost that. If you can repeat it, I'm extremely sorry.
No, I'm just wondering if there are any pockets of exuberance, froth in the market that you foresee, wherein the valuations may have run up ahead of the times and the growth projections, and you would say, take it easy, sound the alarm bells or warning signs here and recommend profit taking.
I think most parts of the markets have run up quite a bit. So to that extent, to a large extent, if you probably look at the entire FMCG story as an example, right? The take here is that the growth will keep on continuing. However, I think rural markets, as we see it, still seem to be under stress. I think the kind of gradual recovery can only start coming through from Q4 and the expectations of a good Kharif season coming through. Obviously, some MSP prices will get announced as we head into general elections. But generally, the volume growth seems to be very, very tepid. And that will probably reflect on Q3, Q4 numbers. The consumption index, specifically the FMCG basket, has also run up with the market. But I think the street might be disappointed if the volumes are not in tandem with the price moves that we've probably seen, and valuations are in no way, have never been cheap and is no longer cheap as we speak. So remain a little bit cautious within the consumption basket on the FMCG space. It all depends on how numbers will play out for these moves.
Okay, point taken. So that's the space which is looking that it might enter the over exuberance stage, but what is showing quite a bit of exuberance in the market is Hudco as well. That stock is up 13%. IREDA yet again is higher by 8%. It's 120 rupees now. Remember, the issue price was around 35 rupees. It's been a 4x stock or a quadruple in terms of the valuation within a matter of 1 month itself. So the ones who've gotten the IPO are definitely very happy about that. Sonata Software higher by 8%. Castrol India, that stock doesn't move so much usually, but that stock is higher by around 7%. And then M&M Financial and Manappuram Financial are the other one which are also doing okay. But let me ask you about the NBFC space, Mayuresh. With this entire rate cut cycle happening, do you think there could be an added trigger for these names, or do you think that in terms of the growth rates, they've already peaked, they're getting in the fresh money as well, so maybe the best is behind?
No, so I think they are penciling into a large extent, Anisha, a large part of the moves that are now getting reflected in price. But with the rate cuts, obviously NBFC players also benefit to a larger extent because the kind of leverage that they can then start giving out with lower rates can be substantially higher than what we speak. Obviously, the NIMs and spreads, which have seen some element of compression, revert back to means, and that creates a positive multiplier effect as far as return ratios are concerned. Having said that, I think the quality names within the broader NBFC theme, names like a Chola, is something that we continue holding on to our global focus lists. Shriram Finance is something that we continue holding on as a clear disclaimer as well. The recent RBI circular also is going to play its part in the next few quarters till the rate cut cycle probably assumes. Shriram Finance, just as an example and a case of point, has only 4% in terms of an exposure to unsecured and personal loans, which are also very adequately covered as far as provisioning is concerned. So in lieu of all these factors, assuming growth to take precedence again in the next few quarters, NBFCs will be in the limelight. But specific qualitative names, leaders within this pack, is something we continue liking. Names like Chola and Shriram Finance as a list.
Right, okay. Let's get in some BTST trades as well before we wind up for the day. Kunal, what's in your list?
So I'll go with a few high beta stocks over here. Indiabulls Housing is the first one to suggesting as a buy, expecting the stock to get into a very big breakout mode about this 210, 212 mark where it's trading right now. So 240 as a target for Indiabulls Housing. Stop loss to be kept at 200. And Balrampur Chini is the other stock which has been struggling quite a bit in terms of the underperformance. But on the RD charts, there are two positive signs which are emerging for the stock, a bullish RSI divergence for the stock on the early time frames, as well as the formation of a bullish candlestick pattern today on closing basis. So would suggest a buy with 410 as a target, stop loss at 375.
Right. Naresh, what about your BTST trades?
So both being banks, the large cap ones. First is the buy on SBI, which is very close to a new all-time high, expecting it to cross soon. Stop loss at 618, target price of 635. Second is a buy on IndusInd Bank, a new 52-week high here. Stop loss at 1538 and a target price of 1590.
Okay, let's begin winding up then for the day. Today, of course, the day belonged to IT, that gap up start, and we managed to latch that. In fact, we're closing in pretty much at the high point of the day. We're staring at a near about 280 point rally on the Nifty futures. We've already made it to that 21,300 print there. Technology, so led by TechM, LTIM, Infosys, which surged about 4%, Wipro up 3%. These have all held out very smartly. Of course, Emphasis, Naukri, these were some of the other names, along with Persistent, which did manage to close in at a live high for itself. There's also been Bajaj Finance, IndusInd Bank, ICICI Bank, Reliance. So the large caps as well participated in today's move. There was SAIL, Indus Tower and Naukri, which were some of the other names which held out as well. So picture perfect market, strong global cues, and we rose up with the rest of the world markets as well. But let's see what tomorrow throws up at us, what sort of cues we start off day with. We'll wind it up right here on this edition of Closing Trades.